Welcome back, everyone. All right, get ready because today we're setting the stage to completely unlock your true net profit. Look, if you've ever stared down a business ledger and just felt totally overwhelmed by the absolute chaos of all those costs, well, you're in exactly the right place. Today, we're going to break down the ultimate profit blueprint in this explainer by demystifying one of the absolute most crucial concepts in business, the difference between direct and indirect accounting. I mean, this is the universal pain point, right? You make a product, you sell it, but at the end of the month, the bank account just doesn't quite match that mental math you've been doing in your head. So where is your money actually going? The confusion usually stems from just throwing all your expenses into one giant bucket. But to truly understand your profit, you have to realize that not all costs behave the same way. Okay, let's dive right into our blueprint to profit. We're going to start by tackling the big accounting confusion head-on. Then separate direct from indirect expenses, take a quick look at direct versus indirect income, and finally, bring the whole thing together into the final profit picture. All right, part 1, the big accounting confusion. Let's get into it. If you really want to master your accounting, asking yourself one single powerful question is literally your ultimate secret weapon. And it's this: are these costs related to the product itself or the business as a whole? Every single time you spend a rupee or a dollar, you need to ask yourself this. The answer to this question is exactly how you classify your costs, and honestly, it's exactly what we're going to master today. Moving on to part 2, direct expenses. This is all about building products. So direct expenses are those unavoidable costs that are directly linked to manufacturing a product or providing your core service. The absolutely key word here is physical. You can physically touch, or at least mathematically attribute, these costs to the specific item you're making. Think about just a standard pen, right? The exact plastic molded to make the casing, the exact ink inside the cartridge, those are direct expenses. You literally cannot make the pen without them. Let's walk through a more physical example. Imagine a client orders a custom wooden door. Every single component involved there is a direct, unavoidable expense of creation. We're talking the quality of the raw wood, the labor for the cutting and design, the specific color and polish applied to it, the actual physical tools and screws used to hold the whole thing together, and of course, the factory wages paid to the carpenter. Every single one of these costs is directly attached to the physical existence of that specific wooden door. And this brilliantly illustrates that when you add up all those direct expenses, the wood, the polish, the screws, the wages, you get the absolute base cost for that specific physical product. Let's say in this case it comes out to 7,000 rupees. That 7,000 is your direct cost, which accountants often call the cost of goods sold or prime cost. Simply put, you cannot build that door for a penny less. Okay, shifting gears to part 3, indirect expenses, which is all about running the operations. Now, indirect expenses are the costs required to run the business smoothly, but they do not change the physical product or its base value. Basically, these are the expenses that keep the lights on, keep the customers coming in, and keep the business moving forward, even if you aren't actively manufacturing a product at that exact second. Here's the logic behind indirect costs. Imagine you manufacture those pens we talked about earlier, and they cost exactly 4 rupees each in raw materials. Suddenly, your landlord raises your shop's rent by 200 rupees. Does the pen suddenly get heavier? No. Does the ink get better? Of course not. The physical pen is completely unchanged. You can't logically attach that random building cost to a single unchanged physical item and tell a customer, hey, this pen now costs 104 rupees. That rent is an indirect expense. Let's look at some classic indirect expenses. We're talking office rent, electricity, advertising, salaries for your admin staff, discounts, bounce check charges, maybe even the office tea and snacks for your employees. These are strictly operational. Think about it this way. If you build a high-end computer and it's just not selling, so you go out and spend 50,000 rupees on an advertising campaign, well, that 50,000 doesn't physically upgrade the computer's hard drive. It just helps the business sell it. And that right there is the essence of an indirect expense. So let's bring this head-to-head battle to life. On one hand, we've got direct expenses like raw materials and factory wages. On the other, indirect expenses like office rent and advertising. The absolute best way to remember this, and if you write one thing down, make it this: direct costs build a product, indirect costs build the business. It is really that simple, and it's incredibly powerful once you finally grasp it. All right, part 4, direct versus indirect income. First up is direct income. This is the revenue generated from your main hustle. It's literally the primary reason your business exists in the first place. Let's connect this back to our earlier example with that custom wooden door. If that door cost you 7,000 rupees to physically make, and you turn around and sell it to a client for 10,000, that 10,000 sale, that's your direct income. You did the core work, you provided the core product, and you got paid for it. Boom.
But on the flip side, we have indirect income. This is the money earned from side sources, things completely separate from your main business operations. For instance, say you run a mobile shop, but you happen to have some business savings sitting in a fixed deposit at the bank earning interest. Or maybe you own a spare shop next door that you rent out to someone else. That bank interest and that rental income both count as indirect income because they are completely separate from your main hustle of selling mobile phones.
And finally, part 5, the final profit picture. Let's bring it all home.
Knowing the difference between direct and indirect is great theory, sure, but let's map these concepts onto actual financial statements to show you exactly why accountants are so obsessed with this stuff. In the accounting world, your direct expenses are tallied up in what's called a trading account. When you subtract your direct expenses from your direct income, it reveals your gross profit. That's just the raw profit on the physical items. But, as we know, the story isn't over. Next, you have to take all those indirect expenses, the rent, the ads, the office tea, and put them into the profit and loss or P&L account. When you subtract those indirect expenses from your gross profit, that is when it reveals your true, final net profit. Which brings us to our final and honestly most important question for you today. Are you pricing your products high enough to cover your indirect costs and actually protect your true net profit? You wouldn't believe how many businesses price their products based only on the direct manufacturing costs, completely forgetting that their sales also have to cover the rent, the marketing, and the office expenses too. But hey, now that you have this blueprint, you are fully empowered to take a hard look at your own ledger. Go audit your expenses, separate the direct from the indirect, and make sure your business is actually making the money you deserve. Thanks so much for joining me on this explainer, and